I'm Angelina. I'm Evelyn.
Yeah, we are from Group 2 and today we are going to discuss a topic about convertibles, exchangeable and warrants.
Convertible security is a bond or a preferred stock that is convertible into a specified number of shares of common stock at the option of the holder. Convertible securities usually have a lower payout than comparable securities that do not have the conversion feature.
Convertible securities provide advantage to both issuers and investors. For issuers, they offer a cost-effective method to raise capital, often with lower interest rates than traditional debt. For investors, issuing convertible bonds can also help provide investors with some security in the event of default. A convertible bond protects investor principal on the downside, but allows them to participate in the upside should the underlying company succeed. For example, a startup company might have a project that requires a significant amount of capital resulting in a loss in the near-term revenues. However, the project should lead the company of profitability in the future. Convertible bond investor can get back some of the principal upon failure of the company, while they can also benefit from capital appreciation by converting the bonds into equity if the company is successful. This bond offers a middle ground between traditional bond and stocks, providing a balance between income generation and potential capital gains. The ability to participate in both debt and equity markets through a single investment can help investors reduce their exposure to market fluctuation and enhance their overall portfolio performance.
The potential of convertible bonds for issuers and how can they mitigate them are as follows. First, dilution of ownership. One of the biggest risks of convertible bonds for issuers is dilution of the ownership. This can dilute the ownership percentage of existing shareholders, including the company's founders and management team. To mitigate the risk, issuers can set a conversion price that is high enough or limit the number of shares issued upon conversion. Second, redemption risk. Convertible bonds often include a redemption feature that allows the issuer to buy back the bonds at the predetermined price. In such cases, the bondholders may demand repayment, which can put significant pressures of the company's finance. To avoid the risk, issuers should carefully evaluate their financial position before issuing the convertible bonds and ensure that they have sufficient cash reserves to redeem the bonds if necessary. And Zaina already explained to you guys about the convertible bonds for issuers. Next, I will explain about the potential risk of convertible bonds for investors and how can they mitigate them. First, interest rate risk. Convertible bonds are affected by changes in interest rates. When interest rate rise, the value of the bond portion of the convertible bond may decrease, leading to a decline in the overall value of the investment. Next, mitigation. Investors can mitigate the risk by diversifying their portfolio, investing in bonds with varying maturities, and staying informed about interest rate trends to make informed decisions. By understanding the risk and implementing appropriate risk management strategies, investors can effectively mitigate the potential downsides associated with investing in convertible bonds.
Next is exchangeable bonds. So I'm going to explain about the definition of exchangeable bond. Exchangeable bond is a bond that allows the holder to exchange the security for common stock of another company. Generally, one in which the bond issuer has an ownership interest. An exchangeable bond gives the holder the option to exchange the bond for the stock of a company other than the issuer at a future date and under prescribed conditions.
There are two kinds of exchangeable bonds apart from normal exchangeable convertible bonds, which are the first, foreign currency exchangeable bonds. In this type of bond, the interest amount and the principal is payable in foreign currency. The offered company, which is the company whose equity shares can be purchased by the bondholder to exercise the right conversion, must be receive foreign investment. And the second, mandatory exchangeable bonds. The bonds have to be converted to equity shares before or on the predetermined date for conversion, and the bondholder is bound to exercise his right for the conversion of bond into equity shares.
These things are the specific advantage of exchangeable bonds. First, flexible investment vehicle. Second, moderate or aggressive options. And the third is has downside protections.
Next are the specific disadvantages of exchangeable bonds. First, lower coupon and yields. Second, forced conversion to stock. Third, investment dilution risk. And the last is exposure to the stock market.
Exchangeable bonds matter because some investors view exchangeable bonds as stock investments with coupons attached. This is because exchangeable bonds trade like bonds when the share price is far below the exchange price, but trade like stocks when the share price is above the exchange price. This correlation with stock price means exchangeable bonds provide inflation protection, which is attractive to income investors and noteworthy given that corporate bonds largely provide little if any inflation protection. Companies often use exchangeable bonds as a method to sell off their position in other companies. But another major advantage of exchangeable bonds for issuers is that they do not dilute the issuer's shareholders. As stated earlier, investors can turn convertible bonds into shares of the same issuer, which forces the issuer to issue more shares and cause dilution. Because exchangeable bonds turn into shares of another company, no such dilution occurs.
The definition of warrants. A relatively long-term option to purchase a stock at specified exercise price over a specified period of time.
The warrants are employed by sweeteners because to obtain a lower interest rate, to raise funds when the firm is considered a marginal credit risk, and to compensate underwriters and venture capitalists when founding a company.
The warrant contains provisions for first, the number of shares that can be purchased per warrant. Second, the price at which the warrant can be exercised. And last is the warrant expiration date.
How does a warrant work? First, warrants are in many ways similar to options, but a few key differences distinguish them. Warrants are generally issued by the company itself, not a third party, and they are traded over the counter more than often on exchange. Investors cannot write warrants like they can options. Second, unlike the options, warrants are dilutive. When an investor exercises their warrant, they receive newly issued stock rather than already outstanding stock, and the warrants tend to have much longer periods between issue and expiration than options of years rather than months. Third, warrants that do not pay dividends or come with voting rights. Investors are attracted to warrants as it means of leveraging their options position in security, hedging against downside risk, for example, by combining a put warrant with a long position in the underlying stock, or exploiting arbitrage opportunities.
There are two types of warrants. The first type is traditional warrants, are issued to conjunction with bonds, which in turn are called warrant-linked bonds, as a sweetener that allows the issuer to offer a lower coupon rate. These warrants are often detachable, meaning that they can be separated from the bond and sold on the secondary markets before expiration. A detachable warrant can also be issued in conjunction with preferred stock. Next is cover warrants, are issued by financial institutions rather than companies, so no new stock is issued when cover warrants are exercised. Whether the warrants are covered in that the issuing institution already owns the underlying shares or can somehow acquire them. The underlying securities are not limited to equity as with other types of warrants, but may be currencies, commodities, or any numbers of other financial instruments.
To find derivative warrants, trading and finding information on warrants can be difficult and time-consuming, as most warrants are not listed on major exchanges. Data on warrant issues is not readily available for free. When a warrant is listed on an exchange, its ticker symbol will often be the symbol of the company common stock with a W added to the end. Warrants generally trade at a premium, which is subject to time decay as the expiration date nears. As with options, warrants can be priced using the Black-Scholes model. A derivative warrant is dilutive because it dilutes or reduces each other's shareholders' ownership in the issuing company. If you hold a warrant allowing you to buy one share in a company that currently has 10 shares outstanding and you exercise it, the number of shares outstanding will increase to 11. You will gain ownership while each other shareholder will lose a percentage of their stake in the company.
Next, I will be summarizing the three types of the bonds. Convertibles, exchangeable, and warrants are financial instruments that give their holders the right to acquire shares of a company stock at a predetermined price, but they have different characteristics and mechanics. Convertible securities. Convertible securities are typically bonds or preferred shares that can be converted into a predetermined number of common shares of the issuing company at a specified price or conversion ratio. They provide the holder with the option to convert their debt or preferred equity into common equity. Convertibles offer the potential for capital appreciation if the price of the underlying stock increases. Exchangeable securities. Exchangeable securities are similar to convertible, but differ in that they are typically issued by a parent company and are exchangeable for shares of a subsidiary or another company. They allow investors to convert their securities into shares of a different company, often a subsidiary of the issuing company, at a predetermined exchange ratio and price. Exchangeable securities provide investors with exposure to the underlying company stock while offering flexibility in terms of the specific shares they can acquire. Warrants. Warrants are financial instruments that give the holder the right, but not the obligation, to buy a specific number of shares of the issuing company stock at a predetermined price within a certain time frame. Warrants are often issued along with bonds or preferred stock as a sweetener to attract investors. Unlike options, warrants are typically issued directly by the company and are not traded on exchanges. However, they can be freely bought and sold in the secondary market. Warrants have a longer lifespan compared to options, often several years, and their exercise prices are usually higher than the current market price at the time of issuance. In summary, while all three financial instruments provide the holder with the right to acquire shares of a company stock, they differ in terms of their underlying securities, the entities involved in the transactions, and the specific terms and conditions governing their exercise and conversion.
Alright guys, that's all the explanation about convertible, exchangeables,
And warrants.
Hope this video will help you guys. Bye bye!